Most new investors get stuck staring at hundreds of ETFs, terrified of picking the wrong one. That feeling of being stuck is why most never build real wealth. The secret isn't analyzing every fund out there. It's building a powerful portfolio using only funds from one single provider. In this video, I give you that complete toolkit. I am going to break down 5 essential Schwab ETFs that act as core building blocks for your wealth. I'll cover a fund for high-quality dividend income, one for aggressive growth, a core fund that owns the entire U.S. market, an international diversifier, and finally, a defensive anchor for stability. I will walk you through each fund's core strategy and the hard data behind it. Pay close attention, because at the end, I'll show you exactly how to combine these tools to construct powerful, custom-built portfolios. The first goal for many investors is passive income. How do you get a steady paycheck from your investments? I believe the answer lies in the Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD's core strategy is to track the Dow Jones U.S. Dividend 100 Index. It doesn't just chase the highest yields, which can often be a trap set by struggling companies. Instead, it screens for about 100 U.S. companies that are fundamentally strong. It analyzes metrics like cash flow to total debt, return on equity, and historical dividend growth. This methodology ensures it holds profitable companies with a proven ability to sustain and grow their dividend payments over time. You're owning quality, mature businesses. The first benefit is the income. SCHD has an indicated dividend yield of 3.92%. The second is the cost. Its expense ratio is just 0.06%. To put that in perspective, for every $10,000 you have invested, your fee is only $6 per year. That low cost means more of your money stays working for you, compounding year after year. So, what's the catch? Because SCHD focuses on stable, value-oriented sectors like consumer staples and healthcare, it can sometimes lag behind the broader market during bull runs. When economic growth is strong and investors are optimistic, they tend to pour money into riskier tech and growth stocks, leaving these more defensive companies behind. It's also not immune to crashes. During the sharp market downturn in early 2022, SCHD experienced a drawdown of minus 19.47%. SCHD is an outstanding choice for income-focused investors who prioritize quality and stability over maximizing short-term growth. It's a reliable engine for building a passive income stream. What if your primary goal is to grow your capital as aggressively as possible? For that, you need an engine built for pure growth. This is the role of the Schwab U.S. Large Cap Growth ETF, ticker SCHG. SCHG's strategy is to track the Dow Jones U.S. Large Cap Growth Index. It focuses on large U.S. companies that are expected to grow their earnings and revenue at a faster rate than the overall market. These are often the innovators and market leaders pushing the boundaries of their industries. This is your tool for capturing maximum upside potential. The most compelling benefit is its performance. Over the last 10 years, SCHG has delivered an exceptional compound annual growth rate of 15.89%. Its cost is also phenomenal, with an expense ratio of just 0.04% or $4 per year for every $10,000 invested. But here's the catch, and it's a big one. This growth comes from concentration, which equals higher risk. The technology sector makes up nearly half of the entire fund, and its top 10 holdings, like Microsoft and Nvidia, account for over 55% of its assets. This means if one of those top companies has a bad quarter, it can pull the whole fund down significantly. This lack of diversification is why SCHG can be so volatile. During the market correction of 2022, the fund experienced a very significant drawdown of minus 31.80%. SCHG is for long-term investors with a high tolerance for risk. If you have decades before you need the money and can stomach the intense volatility, this fund offers a powerful engine for portfolio growth. So far, I've covered an engine for income and one for growth. But what about owning the entire market? In the next section, I'll break down the foundational ETF that does just that. And remember, at the end, I'll show you exactly how to combine these tools to build a portfolio tailored to your specific goals. Picking between dividend stocks and growth stocks is a tough choice. Why not simply own them all? The foundational layer of a portfolio can be the Schwab US Broad Market ETF, ticker SCHB. SCHB's strategy is simple and powerful. It aims to track the Dow Jones U.S. Broad Stock Market Index. This gives you ownership of roughly 2,500 of the largest U.S. companies, spanning large caps, mid caps, and small caps. It's the ultimate one-stop shop for the entire U.S. economy, designed to capture the performance of the market as a whole. The main benefit here is its combination of broad diversification and incredibly low cost. The expense ratio is just 0.03%, one of the lowest you can find. That's a fee of only $3 per $10,000 invested. This makes it an extremely efficient way to get market-like returns without trying to pick winners. Over the past 10 years, it has delivered a solid compound annual growth rate of 12.16%. The catch is that even with thousands of stocks, SCHB is market cap weighted. Think of it this way. If Company A is worth 10 times more than Company B, it gets 10 times the allocation in the fund. This means the largest companies have the most influence. Today, the information technology sector makes up over 30% of the fund. This means that even with a total market fund, your performance is still heavily tied to the fortunes of a few mega-cap tech stocks. In the 2022 downturn, it fell by minus 24.86%. SCHB is the perfect core holding for almost any U.S. investor. It's for those who believe in the long-term growth of the American economy and want a simple, ultra-low-cost way to be a part of it. A portfolio focused only on the U.S. is ignoring about half the world's opportunities. This is known as home country bias, a common mistake where investors feel most comfortable with what they know. To build a truly robust portfolio, you must tap into global income streams. My answer is the Schwab International Dividend Equity ETF, ticker SCHY. SCHY is essentially the international version of SCHD. It tracks the Dow Jones International Dividend 100 Index, screening for quality, dividend-paying companies in developed and emerging markets outside of the United States. Its holdings are from countries like the UK, Australia, France, and Japan. Its key benefit is providing two things at once: a high income stream and true diversification. Its sector exposure is very different from U.S. funds. It has a tiny 2.38% allocation to technology, with much more weight in financials and industrials. This means it doesn't always move in the same direction as your U.S. holdings, adding a layer of stability. It also gives you exposure to different economic cycles and currencies, which can protect you if the U.S. dollar weakens. The catch for SCHY is its short track record. The fund was only launched in 2021, so we don't have a decade of performance data. Its returns since inception have been modest, reflecting a challenging period for international markets. And like any stock fund, it carries risk, experiencing a minus 21.60% drawdown in 2022. SCHY is an excellent tool for investors who already have a solid U.S. portfolio and want to break their home country bias by adding non-U.S. income and diversification. Stock market crashes are inevitable. How do you protect your portfolio from the worst of the damage? For this, an investor needs an anchor, like the Schwab U.S. Aggregate Bond ETF, ticker SCHZ. SCHD's purpose is not growth, it's stability. It tracks the Bloomberg U.S. Aggregate Bond Index, which represents the entire U.S. investment-grade bond market. It holds thousands of different bonds, including ultra-safe U.S. Treasuries and high-quality corporate bonds. Its role is to be the portfolio's defensive line, providing a source of funds for rebalancing when stocks go on sale. The primary benefit is capital preservation. The credit quality is extremely high, with about 71% of its holdings rated AA or higher. When stocks are falling, a high-quality bond fund like SCHZ tends to hold its value much better, acting as a buffer. Its expense ratio is also a rock-bottom 0.03%. The catch with bonds is interest rate risk. Think of bond prices and interest rates like a seesaw. When one goes up, the other goes down. The last few years have been one of the worst periods for bonds in history due to rapidly rising interest rates, which pushed existing bond prices down. This is reflected in SCHZ's 5-year compound annual growth rate of minus 0.97%. This shows that even the safe part of your portfolio can lose money, especially in the short term. SCHZ is for any investor who wants to add stability to a stock-heavy portfolio. Its role is to be boring, cushion the blows during market downturns, and provide peace of mind. It's a critical component as you get closer to retirement. I've covered the 5 tools. Now, I will show you how to put them to work by combining them into 3 different portfolios, each tailored to a specific stage in your investing life. First, the young investor, aged 20 to 35. The goal here is aggressive growth. The allocation is 50% SCHG, 30% SCHB, and 20% SCHY. This is a 100% stock portfolio designed for maximum growth potential. With a time horizon of several decades, the young investor can afford to take on higher risk and ride out market volatility for the potential of greater returns. It's powered by high-growth stocks in SCHG, but grounded by the total U.S. market in SCHB and diversified globally with SCHY. Second, the middle-aged investor, aged 40 to 55. The goal is balanced growth. The allocation is 40% SCHB, 25% SCHG, 15% SCHD, 10% SCHY, and 10% SCHZ. This is a 90 to 10 stock-to-bond portfolio. It's still growth-oriented, but begins to introduce a small anchor of bonds with SCHZ for a bit of stability. The focus here is on accumulating wealth while starting to manage downside risk as retirement gets closer. Third, the near-retirement investor, aged 55 and up. Here, the strategy pivots to securing your wealth, focusing on high income and capital preservation. The allocation is 30% SCHD, 20% SCHY, 30% SCHZ, 10% SCHB, and 10% SCHG. The portfolio's core is built to generate cash flow with a heavy 50% combined stake in U.S. and international dividend ETFs. A significant 30% in bonds acts as a stabilizer to protect your principal. While defense is key, we haven't completely abandoned growth. This structure is designed to generate a reliable income stream while protecting capital, but it still has 20% of growth exposure through SCHG and SCHB to provide some upside potential. You now have a complete toolkit to build a portfolio for any objective. Whether you prioritize growth, income, or a balance of both, the solution can be simple and low cost. If this data-driven approach to investing is what you're looking for, subscribe for more content.